So we walk through diversification and how it can benefit you as an investor. But how can we bring this into practice? Time to introduce you to a couple of investment terms: asset class and asset allocation. First, what's an asset class? There are lots of different types of investments out there, and a lot of them are similar to one another. In fact, some investments are so similar they can be grouped together, sort of like how you have different food groups. Pears and apples are both fruits, whereas carrots and cabbage are both vegetables. For investments, the ones that share common features, risks, and even returns can be grouped together in what we call asset classes. And there are three common ones that you'll be hearing lots about. Equities. These are typically stocks. Historically, equities have been the riskiest asset class. They've experienced the biggest swings in value, but they've also performed the best with higher rates of return than other asset classes. Fixed income. A popular example are bonds. Generally speaking, fixed income products are where you provide a loan for a period of time, expecting that you'll receive your money back at the end of the term. You'll also receive interest payments for your loan. These investments are generally considered less risky because historically their value hasn't fluctuated as much as equities. The trade-off, though, is that the returns are generally lower than equities. Then there's cash or near cash equivalents, which are sometimes referred to as money market investments. This includes treasury bills and guaranteed investment certificates, or GICs. They're usually thought of as the safest of all investments, but historically, this also means that the returns have been the lowest out of all the asset classes. When you diversify, you're building your account so that it includes a mix of different asset classes. This is called asset allocation or asset mix. Basically, it means you're splitting your money into different types of investments according to your risk tolerance and goal timeline. As an example, if you want to keep your risk very low, you may have more investments in cash and fixed income products rather than equities. But if you had a high tolerance to risk and the goals are more than 10 years away, then you may be more comfortable having more of your money invested into equities. This can be a lot to manage on your own, so GoalAssist provides you with the tools to help you along. Once you select a profile that best aligns with your goal, you'll be shown a suggested asset allocation mix. Basically, your asset allocation all comes down to how comfortable you are with risk. For example, let's say I'm saving to buy a condo over the next 3 to 4 years and I don't have a huge tolerance for risk. I may personally panic at the thought of my investments dropping in value and not being able to buy the condo I want. Given my timeline and low tolerance for risk, I may select a conservative profile for this goal. This is an asset mix of 30% equities and 70% in fixed income and cash. But what if I was investing for retirement and able to sleep comfortably at night knowing the value of my investments could go down, say 20% during a difficult market? If my investments were worth $100,000, then that would mean a $20,000 drop. Historically, I know these fluctuations in value lead to positive returns over longer periods of time. And given that I'm still at least 35 years away from retiring, I'm comfortable selecting an aggressive profile for this goal. My asset mix could be 90% equities and 10% fixed income and cash. And what if I realized that I could tolerate some, but not a lot of changes in the value of my investments for that retirement goal? Being somewhere in between means I select a moderate profile. No matter where you land, GoalAssist lets you select a profile or customize one that's tailored to you. Now, did you know you can spread risk or diversify even more? You can, and within each asset class. You can spread your risk in equities by investing into different industries such as real estate, energy, technology, and even more by geographical location, like companies that are based in Canada, the US, or Europe. However, depending on how you go about spreading risk, this can be costly. The more individual stocks you buy, commissions on each trade will start to add up. This can make a dent in the performance of your investments. For example, if you had $1,000 to spend and bought 10 different stocks, you may pay almost $100 in commissions, or about 10%. You may have to make a return of 11.1% just to break even. But if you were investing $10,000 by buying 10 different stocks, then the commission of $100 represents only 1% of the money you may invest. Another thing to keep in mind, the more individual stocks you invest in, the more time you'll have to spend researching each one. For some people, they're okay with this, but for me, I'd rather keep things simple. The good news is there are investment products you can buy to achieve diversification in a more cost-effective and simple way. One example is an ETF. That's what we'll get into in another video.